Purchase items you recognize as an honest need and consider how much you'll save by not buying items that turn out to be wants. Ching! Where was I?
So the key in that video was distinguishing between wants and needs. And needs and wants, it's not so much that we're distinguishing between what's good and what's bad, but just whether or not it's something that if we can't afford everything, is it something that we absolutely have to have? And, you know, so often people get into a situation where they have to decide between needs and needs. You know, so do I eat or do I get my medicine? But oftentimes there are other people who have to decide between needs and wants, and so that's very different. And so if we can distinguish and really be honest with ourselves about what's a need versus what's a want, it's going to make it easier to save. So start thinking about a want that you could consider giving up in order to save or pay yourself first. So for example, my Starbucks habit. If I stopped going to Starbucks, and I don't go that often, but it's kind of like a treat I give myself. If I have an extra 5 minutes between taking kids somewhere, I may say, okay, I'm going to run through Starbucks and get a chai tea latte or something like that. But if I gave that up, and every time I had that urge or notion to go to Starbucks, I set that money aside to save, then that would almost be like found money. Now, we can also agree that when we're saving, we want to see our money grow. You know, you don't want to just put your money under the mattress and then a month later or even a year later, it's still the same amount of money, right? Making regular payments to yourself first, even if they're small amounts, adds up over time. And so the amount your money grows depends on how much interest you're earning, or whether or not you're even getting interest at all, plus how much time you're leaving that money in that interest earning account. So all of that is what we call the time value of money, the fact that what the factors that affect how quickly and how much our money grows is the amount of time we give it and the amount of interest that we're earning. So let me give you an example. Let's say that you've got $1,000, so that magical $1,000 that I was talking about. Let's say that you've got $1,000 that's stashed away under your mattress for a year. The question is, how much will you have 1 year later? Well, how much interest are you getting from your mattress, right? None. So a year from now, it's still going to be $1,000. Or worst case scenario, if you get robbed, it's not going to be anything if they find your stash. So your mattress isn't paying you any interest. But if you take that $1,000 if you take that $1,000 and you put it in an interest earning savings account for a year and don't touch it, so don't take any of that money back out, now you'll start to see that money grow. Sadly, interest rates aren't very high right now, but let's just say the bank pays 0.5% in interest. That's about average. There are a couple of banks that pay a little bit more than that, lots of banks that pay less than that right now. But let's say they pay you 0.5% interest. Then that means 1 year from now, you're going to have $1,005. So your initial $1,000 plus $5 in interest. So interest is kind of like free money. It's a reward for being patient enough to set that money aside and not touch it. So now you might be thinking, well, maybe I should consider taking my money from out under the mattress and putting it in a savings account so I can take advantage of interest. And again, the interest rates aren't very high right now, but it's more than what you would get at home. Well, here are a couple of things to consider when you're trying to figure out where to put your money. First, you want to find out how much how much interest is that bank paying, and how often do they pay? Does the interest compound daily, monthly, annually? So that's why we're showing the little calendar over here. In our example, a minute ago, we gave a simple example where the interest accrued at the end of the year. So if the account you choose compounds interest more often, like maybe daily or monthly, then that's that much more money you're getting because you're getting interest more frequently. So the interest rate may stay the same, but the fact that they pay you that interest more frequently, and then they give you interest on top of the interest that you already got, that's how that more frequent compounding earns you more money. Now, let's get into some terminology. You may hear about something called the APY. That stands for the annual percentage yield. And so it takes into account the interest rate and the compounding period to give you one number that represents how much interest you're really going to get. So the fact that you're getting 1/2 of 1%, but it's compounded monthly or daily, means that you're actually getting a little bit more than 1/2 of 1%. And so that's the number that you want to use when you're comparing different accounts or different offers from various banks. So you make sure that you ask the customer service representative or whomever, or look on their website to find out the APY. And so you can use that to help you shop savings accounts, because not every account is going to be the same. So now here's a handy little tip. It's called the Rule of 72. This is a formula that lets you estimate how long it will take for your savings to double in value. And so we're going to assume here that your interest rate that you're getting is going to stay the same over the life of your savings. So here's how you calculate it. You take 72 and you divide it by the current interest rate to figure out how long it's going to take for your initial savings amount to double. So let's go back to that $1,000 example. If you invest $1,000 in a savings account at a 4% interest rate, it's going to take about 18 years, 72 divided by 4, for that $1,000 to double. So now that you know a little bit about saving and how money can grow, let's look at different types of savings and investment options. Now, I did upload a handout, but I've noticed some people saying that you can't access it while the webinar is going on. But I do have a handout with some of this information on there. And so, in fact, in one section of the handout, it talks about ways to save. So you can refer to that later on. So there are two ways to save your money. You can open a savings account, or you can invest or open some sort of investment account. But the difference between the two, besides time horizon, like I talked about before, we tend to think about savings as short-term and investing as long-term. Another difference is that a savings account might give you federal insurance or FDIC insurance in case something happens to that bank. While investments usually are not insured. So you want to find out about that to see how safe your money is. With a savings account or something similar to a savings account, you can make money by earning interest on the amount deposited. So the bank pays you for the opportunity to use your money and lend it out to somebody else, kind of like in It's a Wonderful Life. So your money is safe, and you can access it by just going back to the bank and withdrawing your money, or maybe even using a debit card or an ATM. So if your money is deposited at a federally insured financial institution, the Federal Deposit Insurance Corporation, so that's the FDIC for short, insures it up to the maximum allowed by law. And so right now that's $250,000. So that means if your financial institution goes out of business for whatever reason and they can't pay you your money, the FDIC will give you up to that limit of $250,000. So unlike It's a Wonderful Life, you don't have to run down to the bank and ask for your money back. if you think that the bank is going to fail. The insurance company will take care of that for you. Now, the FDIC has an online tool called the Electronic Deposit Insurance Estimator. So it lets you calculate the insurance coverage of your accounts at each FDIC insured institution that you bank with. So if you're worried that not all of your money is safe, you can go to myfdicinsurance.gov and they'll show you, help you estimate how much of your money is insured. So now let's look at 3 specific savings options. So we're going to do this kind of in a game format. So let me open up my chat window. So at the bottom of your control panel, you're going to see a little chat window. So I'm going to play a game. And so on your screen, you should see these 3 different savings products. What I'm going to do is I'm going to describe each one individually, and as soon as you guess which one I'm talking about, go ahead and type that in the chat box. So you see the 3 products are the certificate of deposit, statement of savings, or savings account basically, or a money market account. So here we go. Which one is a product in which you leave your money for a set period of time, like 6 months or a year? You have limited deposits or withdrawals. You earn, exactly, April Butler. It is a certificate of deposit. So you get a little bit higher interest rate, but you may pay a penalty if you withdraw before the term ends. So that is a CD. Okay. Now we're down to 2, so I'll just ask you one more. Of the 2 remaining products, which one requires a higher minimum balance to earn interest, pays a higher interest rate for higher balances? Exactly. It's a money market. So the difference between a savings account and a money market account is oftentimes they have a higher opening balance or minimum balance on the money market, but they give you a higher interest rate than on a savings account. Okay, now an investment, remember I said before, we typically think about an investment as being more long-term. But also, an investment isn't necessarily as safe or insured as savings. So an investment is a savings option that you purchase looking toward the future. So, and a lot of banks now sell a lot of banks now sell investment products like mutual funds, but they're not the same as the deposit accounts that we just talked about because the money you invest is not federally insured. So when you invest money, there's also a greater risk that you're going to lose it than if you just put your money into a savings account or a CD that we just talked about. In fact, you could even lose the entire amount you invest if the investment doesn't perform well. So it takes a little bit more education and a little bit more research to start investing. But on the other hand, your investment could earn and grow more than your regular savings account because there's this thing called a risk and return trade-off. The more risk you take on, then the greater your possible return or reward. So in general, the higher the risk, the higher the expected rate of return. Now, you make money on your investments by selling them for more than what you paid for them, or in addition to that, you may earn dividends or interest. So the thing with investments, we want to buy low and sell high. So you want to buy it for as low as possible and then wait for it to grow in value, and then you turn around and sell it at a high price. And that's how you make money on top of the dividends or any interest that you earn. So that money that you get is considered income, and you therefore might have to pay taxes on it. So what you'll have to do if you're thinking about investing is think about how much risk do you really feel comfortable with. And so that's going to gauge how much of a return you can expect to get.
Financial wisdom
from the next president who doesn't appear on U.S. courts. Seems I've missed a crucial step. Retirement. For some of us, it's years away. For some, it's right around the corner. And for some, it was 133 years ago. That's a lot of early bird special. Regardless of whether retirement is a long-term plan for you, or there's already a cookie cake with your name on it in the break room, there are things you can do now to be better prepared financially. The big question is, how much money am I going to need for retirement? For many people, retirement can last 30 years or more. The money you'll need depends on factors like when you expect to retire, whether you continue to earn money from a part-time job, the amount of money you currently have, and the amount you are saving. Some important steps to having the money you'll need for retirement include cutting back on unnecessary expenses and beginning to save for retirement as soon as possible, reducing or getting rid of debt. Develop a plan to stretch your money through retirement so you won't have to worry about running out of money. Well, time to go meet Taft for some mall walking.
Now, I know we're just supposed to be talking about saving for emergencies, but I've got to throw in the long-term stuff just to make sure that we're balanced and make sure that you're remembering that the reason why saving for emergencies is so important is so that you don't derail your long-term savings. Meaning, what I hate to hear about is that somebody incurs some sort of emergency, some sort of huge roadblock, and they've got to go pull the money out of their retirement in order to address it because they haven't saved enough for emergencies. So let's keep that in mind and just briefly touch on saving for retirement. You've got this in your handout that I posted also. And so on that handout, you can just jot a few notes about what retirement means to you. The fact that you want to start saving as soon as possible. Again, keeping that time value of money working for you. You want to try to reduce your debt or maybe even eliminate it altogether. But again, this is all after you've saved adequately for emergencies. Cutting back on expenses will help make it easier to save for emergencies and long-term needs. So let's kind of keep moving with the retirement. So there are different retirement products available for saving, so I'm not going to spend a lot of time on that. But individual retirement accounts, 401k accounts. So the point here is that the retirement savings vehicles look a little different than your short-term or emergency saving vehicles. So now let's just get back to the big picture. What if you say, but this all makes sense and I need to do it, but I just don't have the money to do it? Well, first, it may help to come up with a savings goal. Creating and writing down a personal savings goal and an action plan to reach that goal can really help you with a roadmap for success. So first, you want to think about the factors that may keep you from saving. So why is it that you haven't been able to save or save enough so far? And then think about, of these savings products that we've talked about, which ones make sense for you? You know, is it the savings account? Is it the money market? Is it the certificate of deposit? And then start really thinking about what are you going to do next to reach those goals.
Financial wisdom from the next president who doesn't appear on U.S. courts. When the Treasury called to say that I was to appear on a commemorative $1 coin, I did not tarry in calling them back. But then I saw it. This thing looks like a skee ball ticket. Oh, literally. I put it into a skee ball machine and it worked. 9 balls came out. Oh well, here are some simple ways to fuel your savings goals without making more money. Set up direct deposits or automatic transfers to your savings account. Direct deposit your next raise, bonus, or tax refund right into your savings account. When you pay off a loan, keep making the payments to yourself. Avoid debt that doesn't build long-term financial security, such as loans for a vacation, clothing, and eating out. Pay off higher interest loans first. Join your company's retirement plan like a 401k. A lot of employers match a certain amount of your contributions, and that's free money. Which three of these can you do this week, or next week, or maybe next month? The first key to saving is getting started. The second key is automating the process, and the third key is saving a little bit over time. It adds up. I think I've got enough for a stuffed hippo.
So using your own experience and then what we saw in the video, start thinking about what you can do this week to begin saving. So, maybe it's something like what I was saying, don't go to Starbucks, or stop using the soda machine or the vending machine at work or at school. But just think about some little things that you can do to spend less and save more. And then, think about going even further than that. What can you do by the end of the year? By the end of the year, maybe you can pay off a credit card or pay off your car, or like he said, use a raise to kind of jumpstart your savings. So this is also in the handout. And what this is, excuse me, is just some more suggestions on ways to save. So for example, saving energy. Let's see, I'm trying to see where that is on this handout. But the idea of spending less in order to save more. So if you reduce energy that you use, that will help you save money. We talked about saving the bonus in any gifts that you get. And here's the thing. It's probably not realistic to save all of that extra money. Sometimes we call these snowflakes. It's kind of just a little extra that you're not expecting and you haven't budgeted. But you want to have fun with some of it, but maybe try to save a little bit of it or use it to help get out of debt. And then once you do get out of debt, like the comment he made, keep paying yourself. So for example, if you pay off your car and your car payments are $100 a month, even once the car is paid off, keep putting that $100 a month into your savings account. Maybe it could build up your savings, or it can help you so that maybe the next car you pay for with cash. Some other ideas, paying your bills on time actually helps you save money because you don't get late fees, you don't get maybe over the limit fees, and it builds your credit so that you get better interest rates the next time you borrow money. So lots of different ideas on how you can spend less and save more. So this one was short and sweet today, and the end of our America Saves Week series of webinars, and I really appreciate you all being here. If there are any questions, I can take those, but it's kind of a short and sweet presentation. All right. Thank you all for coming.